This house in Everett, Washington is listed at $469,000, and I'm going to be talking about what it would look like to buy this place with a low down payment so that you can hopefully reference some more concrete and reliable information as you're thinking through a similar scenario. So I'm going to walk you through a real quote with a 3% down scenario and one with a 5% down scenario as well, so that you can hopefully get a sense of what your monthly payment might look like. I'll also break down each of the components of the monthly payment so that you can see how that breaks down. And then I'm going to briefly discuss what kind of income it would take to qualify for this scenario. My name is Landon Buto, and I'm a mortgage advisor based in Bothell, Washington with Cleveland Street Mortgage. And this channel exists to help you in the early stages of thinking about buying a house. So I'm going to walk you through some of the assumptions that I'm using for this estimate, just to show you the numbers that we're using. And these will help us dial in a little bit more accurate of an estimate. Again, just so many things can cause variations to what your pricing ends up being because that's just the way mortgage pricing works. It's not just one, it's not just based on just credit and down payment. There are a lot more variables that end up impacting your total monthly payment. So I'm going to have to assume some things outside of this as well. But these are the most impactful things that I'm going to show you here. Obviously, the purchase price is going to be $469,000. And like I mentioned, we'll walk through a 3% down quote and a 5% down quote. The taxes that I'm using are $46.90 a year, which is 1% of the purchase price, which I'm using because the county tax statement that's available online showed that there's a senior tax exemption. So the numbers that the taxes in the past on this place aren't going to be super reliable. It's going to be a different number going forward. I'm using an assumption of $150 a month for homeowners insurance, and that's just a number that we use as kind of an average for this price point. However, that's something that you're going to end up choosing as the buyer is what your homeowners insurance is, and you could end up with a little bit lower than that. You could end up with a little bit higher than that depending on what your coverage is. But that's a pretty reliable average there. And then I'm going to use a credit score of 700, which is okay. You can obviously, a lot of people will have better credit coming in, and that's great. That can be helpful. In the assumptions that I'm using, one of which is that you are a first-time home buyer. That credit score is not quite as impactful as it used to be in various in terms of specifically your interest rate that's available to you. It will still impact your mortgage insurance, which you have to pay if you put less than 20% down. When you buy a house, you have to pay mortgage insurance, and your credit score will have somewhat of an impact there. So it's, if you're in this ballpark of high 600s, low 700s, low to mid 700s, it's probably not going to vary too much for first-time home buyers. All right, and then real quick, I want to explain this concept of DTI, which is debt to income ratio. It's a key concept to understand. Fairly simple, and I'll just go over it pretty quickly, but just helpful to reference going forward. Basically, there are nuances to this. There's some variation, but we're looking at a conventional loan specifically. So I'm just going to walk through that scenario. There's a little bit different rule with FHA, but I'm just going to look at how it would impact conventional. Basically, debt to income ratio is your total monthly debt over your gross monthly income, and that number needs to be less than 50%. If it's less than 50% up until that point, that's pretty much where lenders will let you qualify. And what that means is they take the resulting total monthly payment plus any other monthly debts you have, credit cards, student loans, any other monthly debts, add those all together and then divide it by your gross monthly income. That's your income before taxes. And that's income in the lender's eyes. That's whatever they deem your income to be. With salary, it's pretty straightforward. It's usually pretty much a 1-to-1 with variable or different scenarios where you're making commission or variable hours. Sometimes what you see your income to be won't be the same as what the lender does. So that bottom number, that gross monthly income, is whatever they see they deem your income to be. So that has to be less than 50%. Again, as a general pattern for conventional specifically. All right, and then I am going to walk through the quote here. So here on the left, you can see it's 95% loan to value. So this is the 5% down scenario, and over here on the right is the 3% down scenario. So again, we're using the purchase price of $469,000. And here, let's just look at the monthly payment and the breakdown here. So 5% down on this place, again, using these assumptions of taxes and insurance, what we ended up seeing is a total monthly payment of $3,635. And then you can see here on the right, so let's look at 3% down. You can see the difference of about $100 a month. On the right, 3% down is $3,734 a month. And you can see where some of those differences come in. Again, obviously the taxes and the insurance are going to be the same on both, but you can see one of the differences comes in the mortgage insurance. On the right, with 3% down, it's $205 a month. On the left, with 5% down, it's $167 a month. So it's about $40 a month of difference. That's a good chunk of the difference between the two scenarios. And part of the reason that is higher is just conceptually it's pretty intuitive. When you come in with 3% down, when you come in with the minimum or a lower down payment, you're going to look a little bit more risky to the lender. Whereas if you come in with a higher down payment, you're a little bit less risky. So the cost of covering your risk is a little bit lower. And that's what mortgage insurance is again, when you come in with less than 20% down, you have to pay mortgage insurance, and it just protects the lender from default when people come in with a lower down payment. That can sometimes be removed, even without fully refinancing, getting out of that loan. That can sometimes be removed. I will try and link here to a video my dad's done on that topic, on when you can get mortgage insurance removed. So let's look at a couple differences on these quotes, a couple more differences. One of the key ones is obviously going to be the interest rate. You can see with the 5% down scenario, it's 6.875, 7.925 APR, and then with 3% down, it's also 6.875, 7.384 APR. And again, that's kind of what I referenced earlier, is there's less of an impact on interest rate based on your credit, and your down payment amount don't have quite as much of an impact on interest rate. They're going to have as they used to, and that's somewhat of a recent change. You're going to see more of that impact in the mortgage insurance. So you see the interest rate's the same. So then the last section that we didn't look at, the last component of your monthly payment, is your principal and interest. And you can see it's obviously going to be slightly higher. It's about $60 a month higher with the 3% down. And now you know the interest rate is the same, so that's going to be entirely from just a difference in the loan amount. You're borrowing a higher amount, so it's going to be a higher monthly payment in terms of what you're repaying on the principal. And then last kind of key section to look at here is the cash you're going to have to bring. Now, in both scenarios, the closing costs, now these are pretty rough, but at this price point with this kind of loan amount, the general number that we use, if people are just kind of asking in passing, we'll do a lot more detailed work to give an estimate, to give a written quote. But if people are just kind of asking in passing, we generally give about $10,000 as a rough closing cost estimate. And so that's about what you see here. And then the difference in the cash to close is going to be from a higher down payment, from the 5% down. So you're looking at a total between But the bottom number here, estimated cash to close, includes the closing costs. So that's a total there of about $35,898 versus on the 3% down, you're looking at about $27,000. So the last thing I want to point out here is around this monthly payment, then what amount of income would you need to qualify? Because we talked about our DTI needing to be at 50% or below 50%. So what income would you need to qualify? So you can pretty quickly get a general sense, do the math on your own, and pretty quickly get a general sense of what you need to be at. So just to give you a more informed, concrete objective, which is the goal of these videos as you're thinking through this process. If you end up with this kind of scenario, this kind of price point, this kind of monthly payment, so on the left is the 5% down, you would need a qualifying income of $7,000, $7,270 a month, and that's about $87,000 annually for the 5% down scenario. And then on the right, with the 3% down scenario, that will be $7,468 a month, which is about $89,000 or $90,000 annually. So again, last note on this, on the monthly payment, on qualifying income, is this is what it would take to qualify for the loan. It's not a recommendation on how much you can afford. That's up to you. And what's important there is I'm talking about qualifying income, meaning it's income that the lenders can rely on. It's income that in the lender's eyes that they approve of you. They affirm that that's legitimate income that you're making and that they can rely on in figuring out how much to lend to you. So if you have things like a second job, some sort of side hustle, or if you just have other things going on that you factor into your income, that can be helpful for your sense of what you can afford. But there are certain stipulations that are pretty rigid as far as what the lenders will deem as what you're making, and so it does have to be qualified in their eyes. But sometimes, if you're making that side money, that's helpful that to know that you can count on it, even if it's not going to increase your qualifying amount. So that's helpful just to be aware of. And if you just have no sense of what's involved in the process, you're just very early in the process of starting to research this, I want to give a very broad picture of what's involved in the process of getting a loan and of buying a house. Generally, we're kind of biased here because we are mortgage people, but we strongly affirm the value of starting out with a mortgage professional because it's going to inform everything else that you do. You can start with a real estate agent, you can start with a mortgage professional. At the end of the day, you're going to need both, so it's not a huge deal. But there's a ton of value in just starting with a little bit of information that's specific to you and having a conversation with a mortgage professional. So as early as you can, we recommend doing that, even if you think, I'm 2 years away from buying a house, I'm a year away, because you can start to take actions that impact how you're set up when you are ready to buy a house, even if it's 2 years down the road, and set you up to be able to afford more or to be able to have better pricing on what you do end up buying. So as soon as you're thinking about it, it's wise to reach out to a mortgage professional and start learning, start seeing what's a realistic option to you, and start making a plan. Once you are ready, then you will do what's called getting pre-approved, and that involves a mortgage professional. So with us, we have our initial conversation where we just get a sense of where you're at and give you an initial sense of where you might be at, how close you might be to your goals. And then once you're ready to get pre-approved and start looking, generally we want to be able to tell real estate agents that you're working with, real estate agents that you're making an offer to the listing agents. We want to be able to tell them, yes, these people are ready for this loan amount, for this purchase price. We've seen everything we need to see and be able to give our word. So we have to see a little bit more information. Once you're ready to start doing that, we gather a few documents to get a better picture of your financial situation. Once you're pre-approved, you can go out and start shopping with a real estate agent. And once you make an offer, you get an offer accepted under contract. Then we work on getting your loan approved. We work with you. We collaborate to finalize how we set up the loan and get all the documentation we need. We get your loan through and approved and finalized, and you get to closing and signing, and you get keys to the house. So if you're wanting to get that process started and just ask questions, my name is Landon Buteau, and our team is licensed in Washington and Idaho. And we'd love to answer your questions over the phone or email for anyone who just wants to ask questions. And of course, if you want to see what it'd be like to work with our team and get a loan with us, feel free to watch the video that's linked in the description below. We have a video explaining what it's like to work with us. From there, we'd love to connect with you over the phone and get you started.